Hello everyone, Stewart Heath here, founder and CEO of Harvard Grace Capital with another episode of our Masterclass series, Questions You Should Be Asking Your Passive Activity Sponsor. This is the second session on questions to ask your sponsor about the investment themselves. So I got 4 questions to talk about today, and be sure to go to our website and download this book. And just use it as a resource. It costs you absolutely nothing. So first question for today, what's the property's current occupancy and at what occupancy level will you achieve break even? There's multiple different kinds of deals. We ourselves like to buy stabilized deals that are generating cash flow and just even Steven try to operate them like that. There are many other deals which will likely have higher returns than the deals we structure, but there's greater risk. So if it's a turnaround situation or a value add, you need to understand at what point the break even. You want to understand the business model. And unless there's some major change going in, you want to understand how the current, the new operator will be able to be more successful than the seller as far as getting occupancy if it's not already at break even. So you need to understand all of those things. The second question for today is, especially for a multifamily or a storage deal or anything, how much of the property needs to be renovated? Sometimes you get into these deals and and the seller got in trouble, ran out of money, and they're halfway through a renovation. So you need to understand how many of these units need to be renovated, how much of the property, and what is that cost. Now, we talked about that a little bit last time. You need to understand the scope of work that's going on. Third question for today, how long before the property is fully stabilized, assuming their business plan works according to plan? This is key, because the whole thing about investing is time. Time kills deals, and if you are 6 months, take you 6 months longer than you think, well, then your returns go down, and you need to understand that risk trade-off, and sometimes you just have no idea the things that can go wrong. Remember, you don't know what you don't know, and you want to make sure that the sponsor has more time built into their plan, and that's been built into the return estimates, so that they've got not just a cost contingency, but a time contingency as well. Because if there's much of a delay, and when distributions start coming out to you, the investor, that can really kill your returns. Last question for today, what's the contingency plan if the rehab costs go high? How much contingency do you have built into the budget? Because you got to have those things when you do new construction. If any of you've ever built a home, or if you've ever been involved in any kind of nothing ever goes exactly according to plan. And frankly, rehabilitation projects are far worse than new construction. New construction, I mean, you pretty much understand your biggest risks are running into rock when you're digging your foundation, or cost overruns before you can get the cost locked in. In a rehab project, you don't know if there's termite damage or rot behind the walls, or if you've got roof joists, and you can only do so much due diligence on the front end. You don't know what you can't see. So you need to understand the size and the scope of the contingency plan. And if there's going to be a cost overrun, there's likely going to be a time overrun as well. So these are detailed questions you should ask your sponsor. And if they don't have really good, solid responses to these, then you might want to take a hard look at perhaps looking somewhere else. Thanks for watching. We appreciate you.